this webcast organized by the IOSCO Asia Pacific Hub in Kuala Lumpur, Malaysia. I'm Salma Hmaidin from the Securities Commission Malaysia. I look after the market development function at SC Malaysia, which includes the development of a facilitative regulatory framework for a vibrant, sustainable and responsible ecosystem in the Malaysian capital market. That we are faced with a public health crisis that has significantly impacted practically every aspect of our lives is beyond question. What has started to gain more traction is how a post-pandemic world can embrace sustainability to ensure that our recovery is impactful, resilient and long-lasting. The number of webinars and discussions being held on this subject is testimony to that interest. As regulators of the capital market and members of IOSCO, we share the common objective of protecting investors, maintaining fair, efficient and transparent markets, and reducing systemic risk. And in this context, ESG issues can have a direct impact to our ability to deliver on our common objectives. To discuss these issues and the implications of COVID-19 on sustainable finance and the role of securities regulators, we are fortunate to have a very distinguished panel here with us to share their thoughts. Erik Thedin is the Director General of Finansinspektionen, the FI of Sweden. Erik is also the chair of IOSCO's Task Force on Sustainable Finance. In April this year, IOSCO published a report on sustainable finance and the role of securities regulators and IOSCO, which seeks to help market participants address issues related to sustainability and climate change. Our second panelist is Amar Gill, who is Managing Director and Head of Investment Stewardship in APAC for BlackRock. As the world's largest asset management firm, BlackRock has made public its commitment to sustainable investing and integrating ESG information into the investment processes. Amar leads BlackRock's investment stewardship team in Asia Pacific, responsible for engaging with companies in which BlackRock invests and working with active portfolio managers on stewardship matters. We're also very fortunate to be joined by Commissioner Efiro Amatong, who is Commissioner of the Philippines SEC. Together with SC Malaysia, the SEC Philippines co-chaired the Sustainable Finance Working Group of the ASEAN Capital Markets Forum, ACMF. In May this year, the ACMF released a roadmap for ASEAN sustainable capital markets. It provides broad strategic direction to facilitate and mobilize private sector capital in the financing of sustainable projects in ASEAN. I want to thank our panel of speakers for being part of this program today. Erik, if I may begin with you, what do you think would be the implications of COVID-19 that has had on the development of sustainable finance? Do you believe that there is a shift towards short-termism at the expense of long-term value creation? And in addition to that, do you also believe that the current environment has helped increase the political will, public support in pushing sustainable finance agenda and embedding sustainability into recovery strategies from this health crisis?
Thank you very much, and thank you for having me, Salma. And I think this is a really good initiative, and it's also kind of characteristic that we are from different parts of the world, because of course a lot of these sustainability issues are very global, and then of course especially the fact, and for that matter the pandemic, which has hit all parts of the world. Well, I think generally speaking, the interest and the focus sustainability has increased because of the pandemic, and that was not, I think, a given, because this was a major economic, it's a health crisis and foremost, but it's also a major economic impact, and maybe the natural response was just to say, well, try to kind of restart or rebuild what we already had. But it seems like the agenda, and definitely this is true for Europe, has been, yes, we need to have a large, let's say, fiscal and monetary input to kind of restart or to keep the economy going, but it's also been directed more into let's say sustainability investments. Also, I think the interest from retail investors have been growing rather than the other way around, which of course has been encouraged by the fact that green investments have been doing very, very well in the crisis. So that is, so I think all in all, the answer to your question is that yeah, I think the agenda for sustainability has increased. Also, sometimes I ask myself, and people ask us, why is sustainability good for financial stability, for the missions that we have regarding stability, as we also a prudential regulator. And I think one thing with sustainability is that it's really long term. Sustainability, I think, is very much equal to long term. So instead of having short term focus, you need to have a long term focus. That's true, of course, for climate change. Yeah, that's true for other parts of the ESG as well. And I think also the pandemic, in what way is the pandemic related to sustainability? Well, I think it shows that you need to have resilience. You need to have resilience in your business model. You need to have resilience in your balance sheet. And that is actually true not only for corporates, who many then invest in through financial markets, it's also true for governments. So I think hopefully we will now have a discussion after and during the pandemic about how to build long-term resilience, not only for the next financial crisis where we typically look on, financial indicators like credit growth, house prices, commercial real estate, risk factors that we know from history has been very, very important for financial crisis, but also more generally saying that the world is extremely uncertain. And when the world is extremely uncertain, you typically should have. So I'm in my private life and on my spare time, I do a little bit of sailing. And I sometimes do this analogy that even if you have had several sunny, bright days, you still put on your life vest. And the reason being that you don't know if the next day is going to be sunny. And we know this is very kind of inherent for all sailors. We know that you should be prepared for a rough sea or for stormy weathers. I think the same goes for the economy in general and also financial markets, that we, even if business are doing perfect and fine and everything goes up in the equity market and real estate market, you need to be prepared, not only because of there is always a risk of a downturn, a recession, a switch in the credit cycle, but also this kind of extreme events, let's say like the pandemic or other natural catastrophes. Well, turning to sustainable finance, we know that climate change will increase the risk of natural disasters, they increase the risk of heat waves, flooding, hurricanes, and extreme weather phenomena. And of course, that is something that goes in line with this. You need to be prepared. You need to have a more long-term focus. So, generally speaking, answering your question, the interest for investing and develop sustainability finance has increased. We've seen this within within IOSCO as well. The support for this task force that I'm sharing has increased. It's increased among members, has increased in the board, and that's very, very. That is of course not because that we are doing a fantastic job. It's because the kind of the general environment in which we work has been extremely supportive for this kind of initiatives that we have taken within IOSCO. So maybe that's I could go for a first try on your questions, Salma. Thank you.
Thank you, Eric. And I think rebuilding or building long-term resilience, as you noted, should underpin our recovery effort in the intersection between health, economic, and financial sectors. Amar, if I could get your thought next on the demand side of ESG investing. Have you found that investors' demand for sustainable products have been affected by the outbreak of the health crisis, and to what extent do sustainability factors impact investment decision in the context of the current climate? Very quickly also, what would your view be on the supply of sustainable instruments to meet this growing interest and demand?
Thank you, Salman. Thank you for inviting me to this discussion. I may need to have a C license to promote any particular type of products, BlackRock sustainability products or high ESG products, etc. That's not my intention, right? So there is huge interest in high sustainability funds, whether it's fixed income or equities, as well as high ESG versions of practically all the funds that we have at BlackRock. And I think it comes down to ESG is very, very highly correlated to quality of management. And in times of uncertainty, what we have had in the last 6 or 9 months now is a pandemic that has caused and been coupled with a big economic downturn globally. So in this kind of environment, investors are generally looking for companies that have good governance generally. And ESG as a factor of looking at the quality of management, the demand for transparency, the demand for understanding how companies are managing the issues, and understanding whether policies were ready for this kind of crisis or whether policies needed to be adapted for the crisis that we have seen over the last 9 months. So transparency has become very, very important. But on the E, S, and G factors, when people talked about ESG over the last 5 years or so, the emphasis has always been on the first letter, on the E, and a lot of commentators and a lot of discussion on ESG forget that there's also S and G. And I think what has happened over the last 9 months is that we are seeing a greater need to focus on some of the other elements of ESG, and particularly on the S side, human management, health and safety. How have companies responded? And as I said, what are the policies that have been in place? How have they responded to the issues of working in closed environments? You've got companies in China with hundreds of thousands of people working in a factory and living in a dorm, and similar sort of situations, similar sort of arrangements with factories and dorms across a lot of Asia, where we have seen some pandemic outbreaks. So I think there's a bit of a shift that we've seen as a result of the pandemic into the other factors like S, the social factors, and governance. I would say that E and S are content issues, and governance is the enveloping structure and processes that the companies have in the content issues of environmental and social factors. And good governance essentially is strong oversight from the board of management and setting in place the right policies and oversight of management in executing those policies. And I think there's also a greater focus on G as well. But keep in mind that all of this, the attention to ES and G factors is also a function of risk appetite. And initially, in the first few months, there was an implosion in markets, and obviously risk appetite also fell away. And then there was a liquidity push into markets, and markets have recovered to various degrees. But risk appetite and the shift towards ESG, to some extent, it's cyclical. When markets are going down, risk appetite goes down. High ESG companies do well. But we believe at BlackRock that this is also a long-term structural trend, that companies need to take environmental and social risks seriously, that there is an implication for their cost of capital. The companies that don't get it, if I can just use that phrase, will see their cost of capital rise. In other words, their valuations come down. And the companies that take environmental and social seriously, valuations improving. In terms of product availability, I think it's less of an issue on the equity side, but in terms of underlying equities, there are lots of companies that we can see, whether it's in APAC or globally, lots of companies that are already making a strong push towards sustainability areas. I think in terms of fund products, we will probably see more impact funds in Asia. I think that's stage right now, the early stage strategies that are looking at what companies are doing that can make a meaningful change in society, and that will have huge potential for growth. I think that's got a long runway ahead of it. Between equities and fixed income, at least in Asia, I think there is more choice on the equity side than on the fixed income side.
Amar, if I may just follow up on that, in an environment of low growth, presumably in the near term, do you think ESG products can compete, effectively compete for investors' interests?
I'm not sure whether it is a function of. I don't think it's a function of high growth, low growth. I mean, when economies and markets are doing well, risk appetite goes up, and investors are willing to take greater risk with lower quality investments. So that's a cyclical element that I was alluding to earlier. But in the environment where you have an economic downturn and you have blow-ups, as we have seen, of some Chinese companies in Nasdaq, and some of the companies listed over here, then the risk appetite comes down, and the shift towards quality happens in markets. So there is a cyclical element, but I think the long-term trend will be towards companies that are taking sustainability issues seriously, and even if it's a low growth trajectory for a few years, I guess the issue about a low growth trajectory for a few years is that interest rates will be lower for a few years as well. Global interest rates will be lower, and similarly interest rates in emerging markets. In that sort of environment, the investors would shift towards higher yield products, and there will be a demand for higher yield. The issue with that, when you move to higher yield or value by the yield definition, is that you have to watch for value traps, and the value traps are companies with low ESG. So even in an environment of low growth, low interest rates, I think to watch for companies that are value traps, whether it's on equities or fixed income, ESG factors remain paramount.
Thank you, Amar. I think as regulators, I think what we're looking for, aside from the widening range of products, is quite importantly the matching with the investor's profile. I think you also raised an important point about the emphasis on E. On this matter, Commissioner Ebb, if I could get your thoughts on from a green investing perspective, it's a key component in the development of sustainable finance. We've observed increasing emphasis also being placed on social impact investing. We see development banks stepping up, issuing COVID response bonds. Could you share your perspective on this aspect, and how are they different from social bonds, and do you foresee more issuances of bonds of this nature?
Thank you for the question, Salma, and thank you for inviting me to be part of this panel discussion today. Let me try to respond to your question in two parts. I'll tackle the COVID response portion first. At least here in the Philippines, what we've seen when it comes to COVID response bonds they are squarely within the concept of social. So yeah, I'm sure you will be aware, and maybe our fellow panelists are also aware, that the ASEAN Capital Market Forum has come up with standards for green, social, and sustainability bonds. And the ASEAN social bond standards are really based off the International Capital Market Association's social bond principles. And I think the key element of the four pillars of the ICMA social bond principles is really use of proceeds. So when we talk about social bonds, and especially ASEAN social bonds, we're really talking about bonds where the issuer has committed to use the proceeds of the bond for a socially beneficial purpose. For example, benefiting underserved groups, minorities, women, providing low-cost housing, providing for health, etc. Now, this epidemic, this pandemic, I should say, in about the first quarter, ICMA itself came out with guidelines to say that social bonds could also be an acceptable use of proceeds would be response for the COVID-19 pandemic, and the response is not necessarily limited to healthcare or the development of a vaccine. But also a possible use of proceeds would be support for people who are losing their jobs, frankly, in this pandemic. And that's the use case, or that's the situation we've experienced here in the Philippines. So one of our top private banks, Bank of the Philippine Islands, in about the middle of the pandemic, so in June, where we were experiencing essentially a lockdown throughout large areas of the Philippines, there was huge concern that micro, small, and medium enterprises would be pushed out of business. And as you know, MSMEs support or provide employment for a very large portion of the workforce. So there was concern that MSMEs would go out of business and people would lose their jobs. So Bank of the Philippine Islands came up with the idea of coming with what they call their COVID Action Response bonds, or CARE bonds. And the intended use of proceeds was to provide additional lending to MSMEs to keep them afloat during the pandemic, and especially during the lockdown. Now, the interesting thing about their bonds, they issued actually within the lockdown, and they weren't expecting much. Their target issuance was something like 3 billion pesos. And what happened was, within the lockdown around June, this social bond issuance we see was seven times oversubscribed. So they ended up issuing something like 21.5 billion pesos worth of COVID Action Response bonds, or something like 445 million US dollar equivalent. So that all of that was kind of unexpected, in the sense that the response from investors was very strong, and they were able to obtain longer term funding. It was only about a year and a half for the bond, but longer term funding for their lending towards the MSME sector. And that's the kind of COVID response bond that we've seen so far. But you mentioned impact investing, and there's this other concept that we've seen and that we're studying closely at the ASEAN Capital Market Forum, of sustainability-linked bonds, where the qualification of the bond as an ESG bond is not based on the use of proceeds, but on the issuer achieving certain predetermined key performance indicators, or KPIs. And this is something we have not yet seen an issuance of, but we are closely watching, both at the regional level and at the domestic level in the Philippines, as possibly something that is more flexible for issuers, and also possibly something that might be more responsive to asset managers or asset owners, in the sense that it's built into the bond issuer. The impact, or the reporting of the impact is built into the bond issuance. So this is something that's new, something that we're studying, but we haven't experienced yet at this time.
Thank you very much. I think that's useful. And again, our focus has always been impactful recovery efforts, and to ensure that the growing divergence between Wall Street and Main Street is narrowed, and the focus on people, profit, and planet is equally managed. And at this stage, perhaps we can address some of the challenges faced in the development of sustainable finance. Eric, if I could turn to your IOSCO Sustainable Finance Network, as highlighted in its report that was published, in fact, in this April, several issues relating to sustainability-related disclosures on ESG data and investments. It relates to reliability, comparability, and the risk of greenwashing. What would be some of the implications of these issues as you see it on investor protection?
No, I think there are huge challenges when it comes to investor protection because it kind of at the same time we talk about the strong growth and how, you know, in a way fantastic this is, that we're actually having more of ESG products, the interest from retailers is increasing, you know, corporates have a better governance. This is I think in generally speaking, there is a lot of positive things with the whole development, but there's also a lot of money to be gained. And of course, there's some financial players are actually taking advantage and trying to self-fund something for green, which is not green. And that is, of course, what we call greenwashing. And I think I think we as regulators have a very, very strong responsibility to say, well, this is, you know, fantastic that we have more green, but let's make sure that it actually is green, so it's not nothing else. And I think, again, we have huge challenges here. What we found out in our report, which it's not, it was to some extent known, of course, before, but we highlighted the fact that we had this disclosure standards, or maybe not standards, basically private initiatives for disclosure. Which, you know, had different angles, a different perspective, have you know, were kind of dominant in different regions. But the overall conclusion was that there was many disclosure standards with limited public interest built into them, and they lack comparability. And maybe even more important, there was no auditing. So basically, you could say as an investor, I'm actually following that and that standard, but no one was really auditing and you know, checking whether the thing you put out in your statements was correct. So I think many of my colleagues within the IOSCO community were pointing out the risk of greenwashing. I've also seen in my own country that when we have seen this, and maybe Amar could comment on this, but we've seen a strong trend to more of index funds, basically low-cost funds, which generally speaking, I think is a very, very good thing, because in a low interest rate environment, it's going to be really important for investors to seek, let's say, less expensive investment funds. So that would be a very, very strong development in Sweden, and of course in many other countries, for retailers to go from high-cost funds to index funds with very, very low cost. Well, some players have said, well, we have this new green fund, which is actually not an index fund. So that's substantially more expensive, but it's green. And then marketing that as the vehicle that you should invest in because it's green. But then, of course, you could ask yourself, is that sustainable? Is it sustainable to push for costly funds that might be or might not be slightly more green than the index fund? So that, I think, is a very, very clear example of, you know, parts of the fund industry have kind of captured or kidnapped the green label and say, well, we bring in this to the fund and then we could charge the retailers substantially more. And I think that is one example. It's not greenwashing, but it's kind of using the green label to actually sell something that might be less sustainable for investors who are saving for their perhaps low pension, or saving for their kids, or saving for their housing. And of course, that kind of investments are extremely irrelevant important, but it's also important that it's an efficient investment, i.e. that it's a low cost investment. So you don't kind of spend all your return on investment management fees, as it were. So no, I think the greenwashing, the disclosure standard, the lack of comparability, there were, and I will probably come back to this later on what we're doing on this field right now, but there are also counter arguments here. So I think it's been wise for the let's say the world community not to go for one standard, let's say 10 years ago, because this is extremely complex. So I think the private initiatives, the SASPs, the PRIs, the GRI, they've been very, very good because they have actually developed and analyzed and they have come up with standards, but to large extent we could build upon. And so it's not that I'm saying that we should have had one single number for green and another single number for social in our financial statements 10 years ago, and they should have been regulated by IOSCO or who else in the kind of regulatory world. I think it's been good that we've had several different that have kind of developed, but now we are at the stage, both when it comes to green investment and the interest of green investment, and also the fact that we have so many standards that are actually used, but are used slightly different in different regions, and there are also different standards in different regions, making it very, very hard for investors to actually understand and compare a company X with a company Y as they use different standards. So I think the whole the discussion about disclosure have been kind of maybe at this stage anyway, the most important issue that we have talked about in the task force, and that we're now also taking some initiatives in.
Yeah, I guess mis-selling and true to label is something that regulators continue to emphasize on. Amar, before I asked you to share your thoughts on the use of sustainability information from companies' report, could I ask you to comment on Eric's point about passive investment, low-cost funds, and the entire true to label concept from an asset manager's perspective?
Yes, sure. And obviously a large part of BlackRock's equity exposure in the public markets is what we call index funds. Some people label them as passive funds, but we prefer the name index funds because in terms of the stewardship responsibility of those funds, we take it quite seriously. So BlackRock votes 100% of votable shares across all our portfolios, whether it's in the index stroke passive funds or in the active funds. We have a stewardship team of about 50 people globally right now, 15 in the APAC region. And as I say, on any high controversial, contentious issues, we look at the voting issues very carefully and determine how we need to vote to protect the interests of our clients, the final investors in these companies. But there is a trade-off in the sense that index funds, as Eric was mentioning, are low cost. That's the business model. And if you're going to do the stewardship aspect of management, then you need scale. If you don't have scale, but you're trying to offer index funds, passive funds, you will be outsourcing your voting to the proxy advisors, essentially. And then the proxy advisors become even more powerful. But the proxy advisors don't have as many people on the ground in India or in the various individual markets in our region and globally. So that's why it's become a scale business, and that's why there are three major index fund providers globally. The active funds, the traditional active funds are being squeezed because most of the traditional active fund managers are looking for outperformance on a quarter-on-quarter basis. Their resources are going towards trying to figure out which stocks are going to outperform or underperform, and they don't put that much resources into stewardship either. Now, green funds that are charging more for looking, for people on the ground to look at what are the real sustainable investments that they should be making. I think the biggest challenge for the green funds is whether the assessments of the, of the sustainability characteristics of a company are for real. There's so many assessors, there's so many third-party consultants on sustainability, so many data providers on ESG rankings, that it can get confused. And so you have a choice between companies like MSCI that give ratings on 15,000 companies globally, or you have your own people going out and doing engagement meetings, and you might do a few hundred or maybe a couple of thousand meetings per year. And so you've got this, these two approaches. And I think all of us would have to, use the external data providers that have scalable rankings of companies, the ones that rank 15,000 or more companies. That's your starting point. And then you need people on the ground to do engagements, to find out how real the data is. And a simple thing is companies may disclose their emissions, their carbon intensity, but you have to know whether this is on a consolidated basis or just on a parent company basis. There are companies in Hong Kong that provide that data on carbon intensity for their Hong Kong operations, as if it was their consolidated operations, when 90% of their output is in China. To measure, they don't include China, they just give their emissions data for Hong Kong. Now, that sort of thing, you're not going to get that information from the scalable data providers. And it's very important, obviously, to have the assessors to assess the real quality of data and information that's being provided by the companies. And the assessors, it's a bit like the audit profession, maybe about 100 years ago. You have different auditors, but the standards of the auditors from one auditor to another in a country and from one country to another can be very different. I think the main urgent matter for green investing is the assessors on sustainability need to be looking out for the right things in the right way, and that the information we're getting from companies is certified in a way that we can have assurance, the way we get assurance from auditors.
So do you think we have enough skills, data, time, and quite importantly, fees to manage these funds and portfolio, you believe?
Data is building up. There are lots of information providers. Obviously, it's up to pay for it. And that's a big question. People talk about the environmental impact of, for instance, flying. But then if you're going to charge a carbon tax, or, you ask air passengers, there is ultimately a challenge of whether customers will pay for it. The way that the industry is ESG factors have become compulsory for traditional funds, all the existing funds, and securities regulators all over the world are ensuring ESG ratings on their funds are credible. And probably that is the way to go. And that will, again, force consolidation, because it's the bigger companies that will be able to do it, the smaller boutique investors.
And I guess from a regulator's perspective, we're looking for where the interests of the investors remain prioritized and protected. I do want to get into the varying standards a little later, but at this stage, Commissioner F, if I could ask, in your opinion, what would be some of the factors that have limited the growth of sustainable finance globally, you think, and what could we do, what ways can we move on to facilitate the shift from it being a niche, or if it's seen as a niche, to the mainstream market?
Yeah, I don't know if I'm qualified to speak about global, the shift from a global niche market to a mainstream market, but just speaking about Southeast Asia and the ASEAN region, I think my observations will very much echo those of Eric and Amar, and I think To try to boil it down to the Southeast Asian experience, two areas of challenge: awareness, or more properly, a lack of awareness about green finance, and a lack of capacity, or a need for capacity building to properly engage in green finance. As Eric and Amar have both pointed out, it can be confusing whether you're an investor trying to make a green investment or a sustainable investment in Southeast Asia, or an issuer, whether on the equity market or the debt market in Southeast Asia. Like a few years ago, I think many of our companies, although if coming from Southeast Asia, environment and the impact on the environment on your operations is a huge concern, because Southeast Asia is among the most affected by climate change. I think we've all experienced the earthquakes, the flooding, the typhoons, etc. So it's built into the business operations, but not necessarily linked to the financial management of many of our companies in this area, because they're simply not aware of the opportunities in green finance. And as I think Eric pointed out, and I think Amar would also agree, there are a lot of funds that are searching for good sustainable investments with a good risk return for the investors. So I think in that sense, the challenge as we see it is to try to provide guidance and guidance to the issuers who want to tap the sustainable finance market, and also some kind of assurance, as I think Eric was also trying to point out, to the investors that they are in fact investing in green and sustainable investments, green social sustainable investments, and are not being waylaid into investing in some sort of greenwashing scheme. And I think our preliminary experience in Southeast Asia has been in the debt market. As Amar has pointed out, it's still very small. But our initial experience with the ASEAN standards for green, social, and sustainability bonds, I think have been, if not yet successful, very encouraging. We were working together, not only SC Malaysia and SEC Philippines, but all 10 regulators of ASEAN, came together in 2016, and in 2017 we introduced the ASEAN Green Bond Standards, again built on the ICMA Green Bond principles. As Eric mentioned, I don't want to speak for other regulators, but I don't feel particularly qualified when it comes to environmental science. I'm a capital markets regulator, so I wouldn't call myself a scientific expert on the environment. But our goal was to work with the market. The private market had already developed some standards that were, or some principles that were well accepted. And so the ASEAN regulators decided to build on that. And as a further quality assurance, instead of coming up with our own list of acceptable green use of proceeds, we came up with a negative list to address precisely the concerns of greenwashing. So we said from the very beginning that no fossil fuel power would ever be considered a green use of proceeds. Full stop. So no attempt to legitimize the use of fossil fuel power as a green use of proceeds. For social bonds, no use or alcohol, weaponry, gambling would be acceptable. So I think these initial steps by the regulators help provide some of guidance to the issuers and some assurance to the investors. It's still early days, but coming from where we were issuing the standards in 2017 and 2018, today around in November 2020, despite the pandemic, there's about $8.2 billion worth equivalent of ASEAN green, social, and sustainability bonds that have been issued within that 3-year period across five countries, including Malaysia, the Philippines, Singapore, Thailand, and Indonesia. Even though the Indonesians don't carry the ASEAN label, they are aligned with the ASEAN standard. So I think, trying to help both the investors and the issuers by coming up with some kind of standard or some kind of guidance, I think will be crucial in order to make it easier for people to tap the market and also provide assurance for investors to invest in these products. We've made more progress on the debt side than we have on the equity side. I agree totally with the comments of Eric and Amar. While I think all of, or at least ASEAN 5 jurisdictions have issued some kind of sustainability reporting requirement when it comes to listed companies. I will freely admit, you can require them to report, but it's very difficult to regulate or police the quality of the disclosure. And again, not being a climate scientist or not having climate scientists on our staff, it's not the easiest thing to review sustainability disclosures. But I think that was a first step. SC Malaysia was very much a leader. The Malaysian capital markets very much, Bursa Malaysia very much a leader in requiring sustainability reporting. But the multiplicity of standards and the difficulty of assessing the disclosure, as opposed to accounting, where you have IFRS as a basis for assessment, and you have audit standards for the disclosure. Very, very different for the equity market. So I think I would agree the equity market much more challenging, even though that's potentially, as I think Amar was saying, a much larger green, social, and sustainability market for all of us. So I think that's a challenge.
Could I ask Commissioner Ed for you to expand your thought on the, I suppose, partnering with industry on having this shift to market-based funding solutions for the ESG space? I think you spoke about the need for expertise, but what are your thoughts on the partnership with industry?
Yeah, so actually partnership with industry is actually one of the goals or one of the points in the focus areas in the ASEAN capital markets, sustainable capital markets roadmap. Because again, we were very much encouraged with our experience when it came to the green, social, and sustainability bond standards. When we began this journey in 2016, to be very honest, we didn't really know how the sustainable finance market worked, and it was in interaction with multilateral development partners like the Asian Development Bank, the World Bank, the IFC, interactions with industry groups like International Capital Market Association, interaction with NGOs like Climate Bonds Initiative. And other bilateral partners. Then we came to kind of get a feel for the market, and we feel that it's very important that the guidance that we put out is enabling and is attuned to where the market is, because what we don't want to do is to provide very prescriptive guidance that is actually misguided. You don't want to use your regulatory power to constrain the market at a time when, as Eric was pointing out, standards are still being developed. So it's very important, we think, to have a close coordination with private industry, better understand where the market is now, and also where the science is now.
Thank you.
And yeah, I was just going to say, and that is included in the strategic plan of the ASEAN Capital Market Forum to have that dialogue with the private sector.
Yes. Amar, at this stage, you mentioned data and a little earlier. Could I ask you to share with us your thoughts on the use of ESG ratings and data? They are a key component to ESG-driven investment strategies. What will be some of the challenges with regards to ESG ratings and data from an investment professional perspective?
The biggest issue with the data that you get from the different third-party assessors on ESG is the correlation between one and the other in the rankings of companies is pretty close to zero. Right? That is the biggest challenge to that credibility and using that data. And ultimately, asset managers have to just decide which one has got the most comprehensive and reasonably credible approach. But this lack of correlation in ranking of companies is something that needs to be addressed, and I think it's gradually moving in the right direction as companies disclose more. The lack of correlation in the scoring is largely because companies do not disclose as much as is needed by these assessors, and then the assessors will have different approaches in how they extract on a company. They might look at other companies in that industry, in the market, or they might just use other ways of extrapolating the data that they don't have. So they're filling in the gaps. And different assessors will fill in the gaps differently and therefore get different scoring. Now, the way, as I said, to address this is the disclosure of the issuers has to improve and has to be providing the data that all the companies in that sector globally are providing. In other words, some international framework of disclosing sustainability data. And the really encouraging trend that or development in the last month or so is that 5 of the framework providers on sustainability reporting, GRI, Integrated Reporting, CDP, SASB, are now working together with IFRS to come together with a convergence in standards on sustainability. And I think that's a very promising trend. And what BlackRock is doing at the same time is urging all our investee companies to provide the sustainability disclosure aligned to TCFD and SASB. And SASB, very, very relevant for investors because of the granularity of the metrics that they recommend, and it would make the disclosure more comparable. So if I think in each market, depending on the development status of the market, the first step is some sustainability disclosure for the issuers. And I think at the same time, regulators may be able to encourage the companies towards a global framework that makes the data comparable. And what a firm like BlackRock is doing is encouraging the TCFD and SASB.
I think stages of adoption may differ, but I think convergence and clarity is critical. I think Eric and Commissioner FF have spoken about the role that securities regulators are starting to take, positive action, engage in multi-stakeholder dialogue, sharing knowledge, experiences, to develop an appropriate regulatory framework. Eric, in this context, there's growing recognition of climate change risks. Could you, at this stage, describe the initiative undertaken by IOSCO to enhance the role of securities regulator to support sustainable finance in capital markets?
Yes, thank you very much. And also, I think I want to refer back to what Amar said about the disclosure standard. So basically, we came out with the beginning of the year saying that one major takeaway was that the disclosure was fragmented. It was very, very hard to compare. I think Amar described it in a very good way. If you try to rate companies, if you try to invest in companies, if the disclosure is not comparable, not standardized, it's going to be very, very hard. So I also think it's extremely encouraging now that the standard setter, the 5 major, have come together, and that the IFRS is also working in the same direction. And as a matter of fact, this is one of the main initiatives that we are taking, is actually work together with these 2 initiatives. And the standard sent an open letter to me a couple of weeks ago, which we answered. And basically, they are asking IOSCO, please get involved, please engage, because we need kind of that public interest oversight body to also be part of this. And it's a fairly, in a way, natural role for IOSCO to take, because the IFRS, which was mentioned here, which is kind of the governing body, let's say, of the financial disclosure, which makes then financial disclosure more comparable and reliable and auditable and all that. The oversight body, the monitoring board, as it's named, is actually shared by IOSCO, now by my Belgian colleague. So as IFRS interacts with the standard set, it's going to be very natural for our IOSCO to also be part of this. This has been, again, a bit of a discussion within IOSCO, how much and how far should we take this kind of role. But I think increasingly the board of IOSCO have said, well, the demand from the private sector, the initiative is so much pointing into one direction. And I think Amar underlines the importance of this, that we need to have a more, let's say, aligned standards also for ESG. That has pushed, I think, the board and IOSCO that, of course, we should be part of this. Well, so that's one very important initiative. As it happens, it's actually also kind of our efforts are very much now, let's say, aligned and working together with the COP26 initiative ahead of the Glasgow climate meeting, whether it's going to be virtual or physical, we'll have to see. But that kind of part, the financial part of that meeting is driven to a large extent by Mark Carney, ex-Bank of England and Bank of Canada governor, who is special envoy to UN Secretary, United Nations Secretary General. So his team, our teams, the standard setters and IFRS are working much more together. Now we will actually have a roundtable in a couple of days' time to discuss this further. So I think you have reasons to be hopeful that we actually could have something to build upon. There is challenges, a lot of challenges, and one that is not discussed that much is that we also have political initiatives in different regions, and maybe this is actually foremost in Europe, where the new Green Deal by the new Commission, they are now pushing for a non-financial disclosure standards. They are trying to set up, their own disclosure standards. So what we need to do on a global scale, well, I'm being a European as well, European Union member as a Swede, but also now then acting in the global scene. We need to say to the Europeans and to other ones that it's fine that you drive your agendas, but try to be aligned with the global initiative so we don't end up with one European standard, one Asian standard, and one North American standard or whatever. So I think it's a very encouraging. It's definitely a core of what we do. And we're not only doing disclosure on corporates and the discussion with the IFRS and the standard setters. There's also work streams working on asset managers, actually co-led by one of the colleagues at the SFC in Hong Kong. So see, the disclosure that we see from the asset managers, which is also then fragmented and kind of sometimes hard to compare. Could that in some way also go in the same direction to have it more comparable? Maybe issue some global recommendations down the road. And also we have a third work stream, very much focused on the ratings. The major rating institutions, what kind of standards do they use? Are they, because we all know that ratings could be extremely powerful and good. We also know that ratings could be extremely dangerous. That's one of the lessons learned from the financial crisis in 2008. So there's the asset managers, there's the rating institutions, and there's then this ESG disclosure for corporates, which are the three kind of work streams that we now work around. And we hope to publish reports on all these three work streams during the autumn and winter of next year.
Thank you. We look forward to these discussions providing much needed greater clarity. Commissioner Ebb, you spoke about the roadmap that's to achieve ASEAN sustainable capital markets. It has a series of recommendations to guide regulators in this region. Could you share some of the priority areas? You spoke about the partnership with industry as one approach. Could you share some of the priority areas and some of the near-term deliverables, and are issues faced by ASEAN different from issues faced by other regions?
Okay, as I mentioned, the ASEAN Capital Market Forum has now introduced we've developed this sustainable capital market roadmap for the ASEAN region, and it's actually been presented to the ASEAN finance ministers and central bank governors meeting, and has received endorsement from the AFM-GM, and it's actually a quite ambitious, holistic attempt to transform all 10 capital markets into sustainability-oriented capital markets. There are 4 priority areas, including strengthening foundations, catalyzing products, and enabling access to in underserved areas, and raising awareness and capacity building. As I mentioned, one of the key concerns that we have among the ASEAN regulators, and also increasing connectivity. Now, within those 4 priority areas, there are 15 identified focus areas, and with 6 of the 15 being identified as kind of low-hanging fruit or near-term goals, including promoting corporate sustainability disclosures, as we discussed, at the very least, introducing the idea of sustainability disclosures to our corporate sector, and then hopefully converging on a more or less common method of reporting. Promoting institutional investor disclosures. I think Eric mentioned this early on, that you want your funds disclosing properly to the investors. If they're going to claim that they are sustainable funds or green funds or social impact funds, then they should be able to disclose properly and guide people who want to invest in those funds. In priority 2, the low-hanging fruit, we need to be developing sustainable and responsible fund standards. So we're thinking that we need to develop more of the demand side within ASEAN, encourage more ASEAN-based sustainability and impact investment funds, improving market access for sustainable products, kind of like regulatory fast lanes for especially for investment products, as we try to develop both the demand side and the supply side for sustainable finance in ASEAN. Promoting knowledge transfer, particularly within ASEAN, sharing of experience. I think this initiative, the Sustainable Capital Market Initiative, has been among the most. It's one of the ASEAN initiatives that has gotten the quickest consensus within ASEAN. ASEAN's not always well known for achieving quick consensus, but in this particular area, for reasons that we are not quite sure of, but we're very grateful for, there was very quick consensus within ASEAN, and we want to continue to encourage knowledge transfer within ASEAN so that all jurisdictions benefit from sustainable finance, and no one is left behind. And at the same time, as I mentioned, we want to coordinate with the public and private sectors in all of these initiatives. Now, having said all of that, and I can't believe that it's kind of ironic that I'm the one saying this now, because this was a major concern of mine. We've had a recent meeting within the ASEAN Capital Market Forum, and though we do not think that it is low-hanging fruit, we're coming to the conclusion that we need to start working towards developing a common ASEAN, for lack of a better word, taxonomy. I don't mean that in the same sense as Europe. Eric has just pointed out the danger of having multiple different taxonomies, but the reality is that as we try to build awareness and capacity within our financial sectors within ASEAN, you get the question, what exactly do you mean by sustainable? What do you exactly mean by green or social? So a common understanding of metrics and terms. I guess the popular term for this is a taxonomy. Is something that we can no longer avoid. Again, I used to be very hesitant about this idea of developing an ASEAN taxonomy because I don't feel as capital market regulators we're particularly better suited as opposed to the scientists. But the demand coming from both the investor side and the issuer side to have common terms and have a common understanding of what we mean by green, social, and sustainable is driving this move to try to develop a common understanding of these terms. And the other thing that, again, not low-hanging fruit, but high in demand is exploring transition standards. Again, part of the ASEAN approach really is to be inclusive. And we are aware that because we've adopted quite strict standards when it came to the green and social bond standards, certain businesses that had a mixed portfolio of green and brown assets, felt unsure about whether or not they could participate in the green transition. When in reality, we all know all of our businesses need to transition. So we're now trying to explore, again, very difficult, a better understanding of transition pathways and transition standards for conglomerates, ASEAN conglomerates, that have not only pure green assets, but are also engaged in brown, but do want to transition towards a more sustainable pathway in line with national commitments to the Paris Accords. So those are broadly the areas where we're trying to move forward over the next 5 years as part of this ASEAN Sustainable Capital Market Initiative. And I think the work that IOSCO is doing on a global scale will be very much appreciated because it's difficult. It's very, very difficult. But again, as I mentioned, the demand is so high within the region for this that we have no choice but to attempt.
It is filled with challenges, but we look forward to ACMF being the trailblazer in this area. Amar, you spoke about the convergence of standards. You have two regulators here. What would you want to see IOSCO's role be in the international efforts to improve sustainability disclosures?
Encouraging to hear from Eric the overarching view that there should be global standards and regional standards that fragment the reporting. The biggest issue for a global investor is that the data and disclosures have to be comparable across the region. As I say, TCFD reporting, SASB reporting is one way to ensure that the disclosures are providing the same aspects of the company's approach to climate change, that's TCFD, and SASB having very granular sector by sector for 77 sectors, what are the metrics of reporting that are relevant for investors? And I think combining those two as sort of, where we should be getting to make global disclosure on sustainability comparable. If we get the regulators helping in that direction as well, I think it would be very, very positive.
Certainly, I think devil is in the details. Data and disclosure being comparable seems to be a critical one. Can I now pose a question to both our regulators on the panel, Eric and Commissioner F. What do you think would be some of the key challenges for securities regulators in supervising sustainability disclosure obligations? Eric, if I may start with you.
No, it's a huge challenge, especially on a global scale, because we don't have the same mandates. If you look globally, we don't issue disclosure standards in my country. We oversee them to some extent, but we don't kind of issue and decide upon them. That's very much a kind of a legal/political discussion. I think that's one thing. But I think what we could do as regulators is, again, coming back to this comparability, to actually both within our countries, in our regions, and within then IOSCO, to push for this global approach to standards. I think that's extremely important. And you need to be realistic. This is not going to be done overnight, but I think now there is a very, very strong, the difference in discussion that I have now with the board in these kind of settings is, more or less 180 degrees compared to a year ago. So it's definitely things are changing. And Amar pinpointed SASB and TCFD, and of course they are part of these standard settings coming together. So I think that is coming back to the discussion on, there's been really good efforts from the private sector, including SASB. TCFD is kind of semi-private because it was initiated by the FSB. But anyway, and now we could build upon them. I think that's extremely important. So no, I think this is one of the few times as you as a regulator get asked by the private sector to do something, to regulate. And typically we are accused of regulating too much, and now I think, and it's not really regulate, it's, harmonize, standardize, make it more comparable. And that is core of what IOSCO should do, I think. It's the integrity of the market, it's the investor protection of the market, is to avoid fragmentation. So I think what we are trying to do in this task force is very, very much in line with IOSCO should do, and also what we should do as local or national regulators.
Indeed. Commissioner F, your thoughts on the challenges faced by regulators?
Yeah, no, I agree totally with what Eric has said, and I think IOSCO can provide a good forum for this discussion. I mean, originally GRI, the approach of the different reporting standards initially, they were coming from different places. The way I understand it, GRI was more about what is the company's impact on the environment, what's your carbon footprint, what's your carbon impact. Whereas you have TCFD requiring companies to think very carefully about what the impact of their activities are, not only on the environment, but the environment on their operations, but also the regulatory commitments by the different countries to prevent a greater than 1.5 degree world. So again, the feedback that I get from Philippine companies are like, we don't know how to do this. We don't have climate scientists in our corporation, and we don't know how to hire them. So there are huge challenges. But I think Amar said a while ago, this is probably where accounting was 100 years ago, with different flavors all over the place. And I think the advantage we have now over 100 years ago is we have IOSCO, where we can have an international forum for this discussion, because nobody wants a mishmash of misunderstandings of these different standards. I think we all want regulators, investors, reporting companies, clarity to as much a degree as we can achieve, clarity and uniformity, like what we have achieved in accounting standards to some extent. So I totally agree with the comments raised by Eric, and I think it's very important work for IOSCO to try to pull all of this together on a global scale, because that's where the conversation really needs to happen.
Thank you. As a final question to all our three speakers, could I ask you to share your personal wish in this space? Eric, if I can start with you. Well,
first is that to somebody end this pandemic. I think that's my personal wish. and hopefully the vaccines will do that. No, I think what I'm I'm going back to my turf. I think that we actually are successful in doing this, and that we have a strong support from both the private sector and my and lawmakers around the world, because we definitely need more of standards. That if we don't have more of aligned standards, the risk of greenwashing, the risk of, that this will backfire, that critics will say this is only the thing that is done for it's nothing for real. It's only things that the finance sector has had come up with in order to earn more money. So we need to have a solid base for this, and I think their disclosures are important, but also the initiatives by BlackRock, for example, actually to push itself and the rest of the community to actually be aligned with the Paris Agreement, because of course this is extremely, bottom line, it's extremely important for our survival if you want to be really serious about this. So we need to get our act together.
Amar?
Well, to respond to that, we are asking all our companies to show their transition pathway. What is their medium-term targets? What's their long-term target to get towards zero GHG emissions by 2050? But recognizing that in the developing world, we're starting from a earlier point in terms of knowledge base, in terms of technology availability, etc. And so the developing world will probably take a little bit longer than 2050. But the targets and how the companies aim to get to that, to peak their emissions in the next 5 to 10 years, which is China's medium-term target. We want to see all the companies aiming to be at least slightly ahead of the NDCs, the nationally defined contributions to Paris Agreement. So that's a sort of overarching background of where how BlackRock approaches the companies. But the one thing I would hope for, what I've mentioned a couple of times earlier, we are urging and hoping that all our investee companies report that the sustainability disclosure aligned to TCFD and SASB, and that makes the comparisons of their disclosure much more meaningful.
And finally, Commissioner Ed.
5 or 3 or 4 years ago, when we started on this journey in ASEAN, we weren't quite sure where it would go or how successful it would be, but it has turned out surprisingly to be, again, something that has unified ASEAN, that has actually contributed to capital market development and growth in the region, across the different jurisdictions. It's been very encouraging in the short term, and then as it has moved forward, we've become more ambitious. And so I can only hope that we are able to maintain and sustain this kind of momentum together with all of our partners, multilateral, bilateral, and of course, important partners like in the private sector and IOSCO, so that we can all work together towards this common goal. As Eric said, it's a matter of survival. This is very, very clear to the people of the Southeast Asian region. We experience climate change as a reality on a day-by-day basis. So this is very, very important for us, and we can only hope that working together, we can actually achieve the goals of the Paris Agreement.
Well, we have come to the end of our session, and I think we got quite a lot done. All that remains for me is to thank our esteemed speakers for sharing their thoughts on this important topic in the webcast organized by the IOSCO Asia Pacific Hub here in Kuala Lumpur. Your insights have been thought-provoking as we navigate sustainability challenges and opportunities, and we all look forward to greater adoption of sustainability finance in our effort to build back better and beyond. Thank you, gentlemen.